Thank you, Jonathan, and welcome back, everybody. My objective over the next 15 minutes is to give you all an overview of hotel performance globally and with a specific focus on the Middle East. But what I really want to do is to get you to answer the question, will history repeat itself? What I mean by that is, I'm going to tell you all about historical performance and my views on the future, but really it's going to be up to you to decide if you think history is going to repeat itself in the future. Now, if I were you, the first thing I would ask is, why should I believe anything Robin has to say about history and historical hotel performance? And this slide answers that question, because at STR we benchmark more than 7 million rooms and 53,000 hotels across the world every day. And that enables us to report back on more than 100 different markets, more than 100 different countries and over 2,000 markets across the world. And just to give you an idea of the depth of that coverage, in Dubai, we have more than 75% of hotel rooms reporting to us data. So a pretty good statistical basis on which to draw some conclusions about historical performance. As I said, as for the future, you'll have to make up your own mind on that. So let's start with global hotel performance and how the Middle East has fared versus everybody else. And the map isn't coming out very clearly there, but hopefully you can make out the various continents. And what this slide shows is 2015 RevPAR change on the left side of each of the regions, and the Q1 2016 RevPAR change on the right-hand side. And the little arrow in between is indicating whether or not that market is trending up or trending down. So I'll just talk through this very quickly and give you an overview of world performance. So starting from the left, and what we've seen is very much a continuation of the trends we saw at the back end of 2015, and that was in North America, a significant slowing of RevPAR growth there. So after more than 6 years of positive growth, it went from 8% in 2014 to 6% in 2015, and is now trailing down at 3%. Moving to Central and South America, actually most of those markets had a pretty good 2015 and a pretty good start to 2016. The one country that's really brought the average down for everyone is Brazil, who are obviously having a pretty tough time. Firstly, obviously losing the World Cup and not hosting it again, and more recently it looks like they'll be losing a president soon. So some political challenges there driving decline in some performance. Moving up to Europe, 2015 was a spectacular year. We saw a lot of holiday destination markets on the Euromed, so the Europe side of the Mediterranean, having fantastic double-digit growth as they benefited from displaced demand from the Middle East and from North Africa. The countries that brought down that average were the likes of Paris, Brussels, London, and Switzerland, where, as you can expect, they lost a bit of traction with some of their key source markets due to safety concerns following various terrorist attacks. Moving down to Middle East, I'm going to cover in more depth later on, so I won't focus on too much now, but suffice to say, 2015 was tough, and 2016 has started even tougher. North Africa, bit of a rebound in 2015, now coming down to earth, particularly around Sharm el-Sheikh. And South Africa, we've heard a lot about this morning, where the weakness of the rand there is causing domestic travelers to have staycations and giving international travelers a buy one, get one free on their holidays. So it's no surprise that market's doing quite well. Looking to Asia, rather large area. I'd summarize it as follows. 2015, the markets that were challenged were China and outward bound Chinese markets in Southeast Asia. And in 2016, we've seen those begin to recover a bit. And down in Australia, bouncing along nicely at around 4%, not too bad at all. So when you talk about RevPAR, you really have to go back and understand the fundamental demand and supply drivers that are driving this performance. And there's only two things they're going to pull out in this, and this is Q1 2016 demand and supply change. The first is North Africa. You can see quite clearly there the reason performance is going down is, quite frankly, because people aren't traveling there anymore, in the short term, that is. Whereas in the Middle East, it's quite a different story. You might be surprised to know that demand grew in 2015 and is still growing in 2016 for the first quarter. Demand is up. More people are staying here and spending nights in hotels. The challenge and the reason why performance has been struggling is because supply has been growing much faster than demand. You can see up there, north of 5% supply growth, much higher than anywhere else in the world. Now, that was just a short-term view I've given. We obviously need to look at a longer term when it comes to hotel investment, and this shows RevPAR indexed back to 2009. Broadly, the bottom of the cycle for most markets. And what you can see from that is that the Middle East, the Gulf, which is the bottom blue line, has had about flat RevPAR over that period, which is quite far behind a lot of the other regions in the world that have had 30 to 40% growth in RevPAR. Now, that might sound a bit disappointing and a bit discouraging, but it's not really a fair comparison. And the reason it's not a fair comparison is because of this. And this is the most important slide in the deck today. Over that period, the Middle East has seen supply growth of more than 40%. You compare that to the rest of the world, most markets didn't see anything near more than 5 to 10% supply growth. So anytime you have that much supply growth, you are going to have some challenges in the performance of the hotels that were in the market in the first place. The really good news, though, is the next bubble, which is over that period, demand has increased across the Middle East by a staggering 51%. Now, when I first came to the region back in 2008 and 2009, I was doing a lot of feasibility studies, and I remember myself, much like everybody else at that time, had said, you know, there's a real problem here. We have supply growth and a pipeline of more than 50% of current supply. And we have a big global recession underway. And you know, the view that we gave our clients back then was there was absolutely no way that the markets could hold RevPAR at the current levels in that kind of environment. And in a way, it's not that dissimilar to where we are today. You know, we've got significant supply growth coming up, which I'll talk about. And we're at the beginning of what appears to be a bit of a shock to demand. So going back to the question I asked you, will history repeat itself? This is a very important slide. Because over that period, supply grew 40%, demand grew 51%, which means we had double-digit growth in occupancy. Quite staggering if you think about that growth in supply. Rate did slip a bit, down 9%, but a bit unfair because if you looked at this at the end of 2014, rate would have been positive. We saw that 2015 wasn't a great year, and that was mostly rate decline across the region, which had a lot to do with dollar strength, making it a more expensive destination. So overall, I, and many of the other advisors at that time, were wrong, which is why you should probably never believe any forecasts, because the market did actually manage to hold RevPAR across that period, despite all that significant supply growth, despite having to deal with the recession, and managed to grow at more than 42% in total revenue terms. So that takes us nicely to where current supply is, because as I said, it's no surprise, everybody knows there's a lot of hotels being built out there, and when you look at the Middle East, as these numbers show, it's ahead of everywhere else in the world again, with current pipeline representing about 52% of current supply. So if it all got built, supply would grow by 50%. Not too dissimilar to the situation back in 2008. In terms of under construction, well, about half of those rooms are currently under construction. So not all of that's going to open up in the next year or 2 or 3 years. But I think you can expect a fair portion to open up over the next 5. Which takes us nicely to forecasts. So we forecast many markets around the world. And, you know, in the majority, we expect most markets to actually have a pretty good 2016 because we believe in the long-term fundamentals of tourism. And whilst there might be some markets that lose out, we believe that will generally shift to other markets, much like the airline arrivals data showed earlier. As you'll see, Dubai is on there as one that looks like it's going to have a struggling year this year. And I don't think there's any denying that. But the real question you have to ask is, what is the long-term perspective? People don't build hotels for 1 year. They build them for 20, 30, 40, 50 years. And that's the thing you need to answer if you're investing in hotels. And with that, I want to really focus on the Middle East region and cover a bit more about performance, RevPAR performance by country, as well as F&B performance, and ultimately, and most importantly, profitability. So the good news is, and I like starting with good news, is as you might have seen from one of our recent press releases, the Middle East, the markets in the Middle East generate fantastic RevPARs. They are some of the highest RevPARs in the world. On average, they are more than 50% higher than the averages you see in Europe and the US. And if you look at a market like Dubai, for the first quarter of this year, it had the highest RevPAR out of any city in the world. So fantastic top-line rooms revenue. And this is after it had declined quite significantly during 2015, which you see on this slide, which is 2015 RevPAR change by those countries. Now, there's a fair amount of red on there, but again, the story that doesn't tell is how those markets have been able to absorb supply growth during 15. I'll give you an example. Abu Dhabi, 1% growth in RevPAR. Sounds good. Well, actually, that's pretty fantastic because supply grew 7% in Abu Dhabi last year, which means that 1% is actually 8% market growth, which is fantastic. Dubai didn't manage to do as well, but it also had 7% supply growth, and some of its key inbound markets, particularly out of Russia, it was becoming a lot more expensive for them. Looking at 2016, then, the first quarter of 2016, clearly, as I said, it's been a much tougher start to the year. And whilst occupancy has held steady in most places, with the exception of somewhere like Sharm el-Sheikh, which is virtually closed, a lot of the other markets, even Dubai and Abu Dhabi, have actually had flat occupancy so far this year. So the declines that we've been seeing are mostly rate-driven. And I think the response or to that has to go back to what Alex Kyriakides was saying this morning is, whilst all this is going on, you've got to focus more on intra-regional travel, which represents about 50% of the demand in the area. Where that decline's been coming in terms of source of business, I think it's been more on the leisure side, as you can see from this slide, which shows change in RevPAR between transient business and group business over the last couple of years. And you can see group business there down at 15% RevPAR declines versus transient at 10%. Looking then at supply growth, it's, as you can see, it's spread across the region. Most markets having significant growth, particularly Abu Dhabi, Dubai, a lot of the Saudi markets. But there is a reason that everybody is building all these hotels. Despite what some people might think, investors in this market aren't stupid. The reason they are building these hotels is because they fundamentally believe they will generate a good return on capital. And the reason for that is because, firstly, the rooms revenue, which I've pointed to, the RevPAR, which is at some of the highest levels you see in the world. Secondly, F&B. So we've recently started benchmarking F&B, particularly in Dubai, looking at performance by square meter, by guest, by outlet. And it's revealing some interesting results. Firstly, that the level of F&B revenues is unsurprisingly very high relative to rooms revenue. This is a market where you can actually get people from outside the hotel that aren't guests to eat and enjoy F&B in the hotels. That's not something you get in many other markets in the world. And you can see as a result that if you look at F&B across a year, it fluctuates less than rooms revenue. So when tourists aren't coming in the hottest months, the locals are still eating in the hotels. So that gives some protection. In terms of how F&B revenues are trending, you can also see that whilst they trend and correlate pretty close to rooms revenue, they do offer a bit of protection, and they haven't declined as much as rooms revenue have in recent months. But getting back to the most important reason why people are building all of these hotels, and that's because they believe they will be profitable. And this slide shows profitability for each of those main markets. And I'll just explain it quickly because there's a lot on there. So the blue bars are GOP, or gross operating profit per available room per day. So, in Jeddah, Dubai, north of $150 a day in profit per room. The really important one, though, is the red dots. The red dots is the profit margin. So you can see, again, Jeddah, Dubai, Doha, Riyadh, all 40% or above profit margins. Now, those are pretty fantastic profit margins. The only other places you see profit margins like that are in markets like London, where you're having to pay a 4% yield for an asset. So pretty fantastic profit margins. And yes, there are some headwinds. And if you look at the bottom, it shows the change in profit in GOP over the last year from 2014 to 2015. There are some headwinds, but fundamentally, those are high levels of profitability, which should, over the long term, enable you to generate a good yield on your investment. So just to finish, I'll get back to the question I originally asked, which is, will history repeat itself? You know, clearly, there are some challenges ahead, but I think the message is, don't panic. You know, we've been there before. We've seen supply growth like this. We've seen demand shocks like this. And we've seen the market being able to absorb all that supply growth and recover from those demand shocks. And when you look at the long-term tourism fundamentals that we've heard about this morning, when you look at all the theme parks that are opening up and all the visitor attractions, when you hear about the growth of both Etihad and Emirates, you know, there's a lot of good news out there. And whilst the next couple of years may be difficult, you know, I think you'd be pretty hard pressed to bet against this region in the long run. So whilst I can't make up your mind for you, I will leave you with the one maxim that I always remember about Dubai and the Middle East, which is, build it, and they will come. Probably.
Excellent. Thank you, Robin.
You may wonder how this guy is going to get it right, telling us what tomorrow is going to be. I don't have the crystal ball, ladies and gentlemen, but if I had it, I will play the lottery and I will retire very soon. But with hard work and careful consideration of market dynamics, we can prepare for what may come tomorrow. And in January 2015, we've published the first edition of the Colliers International Market Forecast, which covered 29 core and sub-markets in Middle East and North Africa. And how did we do it? Well, at December 2015, we had a margin of error of 5.3% on RevPAR, 2% on ADR, and 4% on occupancy. Hands on my heart, the advice we've been given to date is a calculated risk. So you are in safe hands. Will I have the same attitude next year when Jonathan will invite me? I hope so. And probably, I will do this. But, you know, a bit of luck is necessary everywhere. Let's dig straight into the figures. This is our opinion of where we see the RevPAR at December 2016 in US dollars. If you look across these 29 core and sub-market, I call sub-market because Dubai, we have broken it down into district. So the cluster, we believe, have a segmentation in their own rights. So like Dubai Creek and Festival City, Sheikh Zayed Road and DFC and so forth. So to give a better understanding to the readers of what are the local dynamics and where may that patch end up at the end of the year. What is interesting to note about these figures is that everybody panics. Oh, yeah, you know, the market is going down. You know, we don't know where it's going to end up. General manager, oh, my figures are down for last year. I was with a general manager last week. He said, no, my business is down. I said, what's your occupancy? About 79%. And what was it before? 83. So we are used to very big double-digit numbers, and now we are panicking. And the difference between 2015 December and what we see in December 2016 is that if we look at occupancy, only there is a drop on one market from a 70%. 11 markets of these 29 had occupancy well above 70%. In December 2016, we're going to have 10 markets that have occupancies above 70%. So, and they are almost the same markets. They are in there. No major discrepancy, no major surprises, you know, calculated surprises. What about average room rates? You know, 2015, we had 13 of these 29 core markets above the $200. What we're going to be at 2016, 10 of these markets going to be above the $200. What about RevPAR above 150? Before Robin was talking about 130, the average for, the region. Is so above 150, the drop is considerable. From 9 to 4 markets. Who will be this solid market? Dubai, the Creek, Palm Jumeirah, Dubai JBR, and Jeddah. Very strong market, no big surprises. So, as you can see, this is the variance of what we see, the picture for the RevPAR at December 2016 compared to the same period, 2015. Yes, they're all negative. I'm not here preaching that is a pink picture. You can see on the far, on your far right, that only 5-6 markets will have a positive growth in RevPAR. Across the spectrum, this is the effect, particularly on average room rate. The majority of hotels are lowering average room rate due to the economic effect, macroeconomic effect. Some are panicking. And why? Because they have large amount of F&B outlets and they maintain footfall to generate enough revenue to cover the break-even of food and beverage outlet. So it is purposely done to keep the volume coming in. It is also aligned with the macro force like airline business. Do we still have the same customer that come and buy the seafood platters? I would say that today is more a club sandwich than a seafood platter. Why? Because it's an economic reaction to the downturn in economic condition and spending power from our source market. So it's a very practical indication to show what is happening naturally and what is happening strategically. It is not a situation of panic. It's a moment to reflect, prepare, and react to what may come. What is interesting to note on these RevPAR changes, Abu Dhabi City, Abu Dhabi Beach Hotel like Sadia, Thailand, Dubai JBR, Jumeirah Beach Residences, Ras Al Khaimah, and I'll come in a minute to that. All these markets are consistently maintaining level of occupancies with a slight drop in average room rate. One very good market to watch is Manama, which will have a positive growth in RevPAR because they've been able to grow both the occupancy and the average room rate and continue to be so. Robin figure proved my point. Q1 year to date, fantastic performance on Manama, Bahrain. Kuwait City, very interesting market. No massive changes for the past 5 years. Kuwait City, we will see a static occupancy, no major change, but a double-digit figure growth in average room rate. This is quite an unusual scenario for talking about Kuwait City. Kuwait City has been a very predictable market, very static market. No major change, no major fluctuation. It's the first time I'm standing in front of an audience in 6 years talking about double-digit growth in average room rate in Kuwait City. Why? There is no growth in supply. So the local hotels are penetrating the market, are capitalizing on very long-term relationship and growing their business nicely. Last but not least, and in my opinion, what I would define the most consistent hotel market in our region in terms of key performance indicators. And there my admiration is Ras Al Khaimah. Ras Al Khaimah have consistently improved in the key performance indicator. And to maintain the volume, the footfall for their hotels, because they're very large establishment, they're very exclusive establishment like the Waldorf Astoria or the Rixos on Marjan Islands, they are, in my opinion, and what we see, reducing the average room rate to maintain the volume. But again, it's a marginal drop, not a massive drop. As you can see, it's only a decline of 2% in RevPAR, which is purely from a drop in average room rate. So, fantastic market to invest. This boxes is a traffic light analysis to highlights the major changes that we are forecasting, positively, negatively, and in balance between 2015 and 16. Obviously, no surprises that the Egyptian cities of Alexandria and Cairo, they're coming for a much lower base, considering the social unrest that characterized the market in the last 4 years. So hence the reason double-digit growth and in pole position in terms of RevPAR change. It would be different if their RevPAR was $100 higher. It would be no different than any other markets. Sharm el-Sheikh and West Bay Lagoon, Qatar. Sharm el-Sheikh, we all know the story, and it is very much a macro force. West Bay is a combination of the lack of brand new property. The only one is the St. Regis, in terms of good product, and product need to be updated. So West Bay in itself, not West Bay Lagoon, is picking up some of the businesses, and Banana Island, like the Anantara of this day, with brand new product that is taken from the older property of West Bay Lagoon. But we will see these changes in the 3 years to build up to 2022. This is just to give you a highlight of where we see the biggest changes in occupancies growth or decline, and average room rate growth and decline for the period ending December 2016. However, we are soon releasing next month what will be our prediction of Dubai leading to 2023. Why 2023? Because we believe that from Q3 2017, so after the summer next year, to Q1 2023, we will experience, particularly in Dubai, a consistent growth year on year on a single digit, and the magic number we are today working upon is 8.3%, leading to 2023. What will happen in 2023, in our opinion, looking at economic situations and the economic cycle of the past 10 to 15 years, we will have another static year. And this is a combination of what is being built in Dubai, the Dubai parks, IMG World Entertainment on Sheikh Mohammed bin Zayed, calendar of events, supply pipeline, airline growth, and economic stability. Combined with our neighboring country like Qatar, which going to have the World Cup in 2022. And we believe there is induced demand that will be generated for the market in Dubai. So the key message to take away, Q3 2017, Q1 2023, single digit growth consistently year on year. And the magic number we're working upon, but we will release accurate forecast, is 8.3% growth year on year for Dubai. I just want to repeat it, Dubai, not the region. What is the takeaway? Also, where would I invest my money today? Today, there are some clear market, and this is my final thoughts for the forecast. Where would you invest? Where we see the best growth coming up in the next 5 years? Number one is Ras Al Khaimah. I know they don't like it, what I'm saying, what I'm going to say, but for some reason, by default, many of the DMCC agents have labeled it as affordable luxury. Spot on. Amazing destination, in my opinion, and in our professional opinion, is going to be the new Saint-Tropez of the UAE, Ras Al Khaimah. Followed by Dubai, no brainer. Manama, Bahrain. Manama, Bahrain, we believe, there is a new growth, a new era in the new product coming up. The quality of hotels they're building, the lifestyle hotels they're going to come in, is going to be again in the global map of as a destination. West Bay Doha, service apartment, in particular service apartment. Plenty of lifestyle hotel, plenty of five-star hotel, good service apartment product will do very well with a consistent growth, particularly average room rate. Abu Dhabi, Saudi, Thailand, absolutely the Malibu of the UAE. Fantastic. Five-star resort, quality housing, beautiful villas, a purpose to visit. And we're very popular from CIS and European countries. Last but not least, and close to my heart, spent 6 years of my life in and out, is Saudi Arabia. Saudi Arabia, beside the traditional Jeddah, Riyadh, Makkah, Medina, Dammam and Koba, there are 12 cities that, in our opinion, potentially, with the new initiative that the government is introducing, will have double-digit growth, starting from Halasa, Ofuf, Buraida, Qasim, Taib, Hail, Abba, many more. These 12 to 15 cities will be what will fuel the growth of the tourism of Saudi Arabia, particularly domestic. Thank you very much.
Great, thanks, Filippo. I see a couple of hands about to come up, because I know Scott Antel probably has a question to ask, or Andrew Sangster over there I can see in the front row, because Andrew always has something to say, as do you, Scott, actually. But first of all, thank you for those presentations, excellent slides. I understood what you guys were saying, which is great. I know you have a lot of figures, so it's often difficult to bring it down and make it understandable for people. But it seems like your top destination, if you were to put money down, it would be Russell Cameron.
Absolutely.
What would yours be?
Honestly?
Yes?
Southern Europe.
No, come on.
No. I think I got asked that question this morning, and it is a difficult one. The market is going through a lot of flux, and there's a lot of supply coming on board, and I think you have to think very carefully about where you invest. I'm bullish about the long-term prospects, but I don't know enough about individual markets.
You're sounding like a consultant now.
Well, I was for 13 years.
All right,
you
were, that's right. Ex-Deloitte. Okay, so we talked a lot this morning about oil and Iran. And actually, it's two areas that you guys didn't really discuss too much, because it'd be interesting to hear, first of all, Iran. You probably don't have the numbers yet, but something you're working on, I suspect. I mean, that must be, for a lot of the industry here, it's right up there in terms of trying to get in. Yeah. And secondly, how is oil impacting the price of oil at the moment, impacting demand?
Sure. I'll talk about Iran, Filippo. I don't know if you want to talk about oil. So I guess on Iran, what I'd say, I think the really interesting thing there is, yes, the domestic market, but also how you get outward bound tourism from that market to start coming into the region. Obviously, it probably is a bit more challenging for Saudi, but for many of the other regions, there must be a big opportunity as people get wealthier there, open up, want to travel, that they start coming to within the region first. Yep. And as that happens, there's got to be opportunities for brands here to go into that market. There's a lot of business that's going to be done there.
All right, great. Filippo?
It certainly impacted particularly the corporate market domestically and regionally. Why a lot of the oil company are downsizing workforce, all the company, the stakeholder of the oil and gas industry are downsizing. So it is affecting both the corporate and the MICE business. However, on a positive note, I think, the recent paper issued by, His Highness, the Deputy Crown Prince in Saudi Arabia, Vision 2030, shows that, it was very much needed. We were too dependent on, on a single commodity, and we generate a lot of cash, and don't get me wrong, but, economically speaking, diversification in any economy, and this is, happy to be challenged on this, comes from two sectors, tourism and manufacturing. And particularly in tourism, they are well placed to capture, probably 50% of the population from an airspace point of view. And therefore, yes, it's impacting, but it's also made us reflect on how to diversify. And Saudi Arabia Vision 2030 suggested that, His Highness want to stay away from oil, as much as they can.
Yeah, so there's more money coming into the industry, and of course for employment
Absolutely.
reasons, it makes huge sense, doesn't it? I think we got time for one more question. If anybody has a quick question for these two chaps, Scott, do you want to have a question? Okay, if we could get a mic over to Scott.
I'm not sure you're the two gentlemen to ask, but this morning there was a lot of talk about security and the issues impacting the region, and I want to look at risk and the reality and perception. The reality is, if I travel in America, I have a far greater chance of being killed by an American white citizen from the South who bought his gun at Walmart than I do by a Muslim terrorist. If I'm traveling in Brussels or Paris or Istanbul, I have a better chance of being killed by a bus than I do by terrorism. So that we have this difference between perception of risk and the reality of risk. And perception is impacted by the news and also by government officials. And there's no question that the Middle East, even though the UAE is quite safe, has a perception problem.
Yep.
What do we do to change that, particularly focusing on the media, and I'm all for free media, and also government officials who use this as a tool for political means rather than the benefit of an economy?
Yeah, I mean, I think you're 100% right. It's perceptions more than reality that drive any kind of consumer behavior. And yes, you know, you're absolutely right in all the statistics, and it's a really difficult thing to change. You know, obviously marketing helps, but you know, I think fundamentally, until you get stability in the wider region, it's always going to be difficult to overcome that.
But just following up on that, you guys are now tracking the performance of markets before, during, and after events, be they, you know, sporting events or terrorist action.
Yeah.
Are you seeing what trends are you seeing?
So yeah, I mean, we've recently done some work on that, and you saw some this morning on the airline arrival side, which painted a pretty dire picture on the impact of terrorist attacks and events like that. The analysis that we've done for the hotel sector specifically, looking at hotel performance, isn't anywhere nearly as bad, and that's because in many markets there's a huge amount of domestic tourism as well as international arrival tourism. And so, you know, we've gone back and we've looked at the impact of the Madrid train bombings, we've looked at the impact of the London 7/7 bombings, and we've looked at the most recent terror attacks in Paris, the impact of that in Brussels and in London, and then more recently. And you know, the headline was actually that the hotel sector was far more resilient than you might think, that it took 3 or less than 3 months for the market to stabilize. So generally rates weren't discounted, and occupancies did decline in the order of 15 to 30, depending on the event, % in that period. But within 3 months, occupancy had stopped declining. And for where we could look at the analysis, the following 12 months, that occupancy drop was recovered.
Right.
But I think that analysis was in the backdrop of there not being continual every couple of months sort of a type of event like that in any of those markets. So it'll be interesting to see how things recover next year. But certainly, if you look at Brussels, had stopped declining before the most recent attack. Mm-hmm. And Paris, whilst was still declining, had pretty much stabilized again until the recent Brussels attack.
Okay, great. Well, listen, I think we better end it there. We're running a little bit late, but chaps, thank you very much for participating on this panel and your fascinating data that you presented to us. So please show your appreciation to Filippo and our STR
Robin.
Robin. Okay.